Bond markets are sending warnings for 2026. Are investors ready? As global bond traders look toward 2026, the cycle is no longer moving in sync. Inflation, growth and monetary policy are diverging sharply across major economies. Treasury markets already look uneasy about what comes next. They're rebuilding risk premium well ahead of the next year. So should investors be preparing for something to break, and where are the fault lines? Laura Cooper is head of macro credit at Nuveen. So Laura, 2026 could mark the end of the rate cutting cycle for many central banks. Does that mean it could be a challenging year for bonds?
I think it's going to be a challenging year because what we're seeing is the end of this synchronized monetary policy cycle across developed markets. And instead, fiscal policy is going to matter more for financial markets. We are seeing these elevated deficits. And so I think those dynamics are going to matter more for growth, inflation, and term premia. So this is a backdrop where we're not chasing duration, particularly in the US. We're leaning into further curve steepening because investors will want more of that higher term premium. And I think overall, this is going to lead to a structurally higher for longer backdrop for yields. And while that may not be a great environment for bonds, it is an overall attractive space for fixed income.
Well, there is the potential to lurch into the unknown of super low rates if President Trump gets his way. Could changes to the Fed's reaction function really rattle markets?
I think the Fed independence is a lingering question that's continuing to loom over markets for next year. Now, that being said, we did have the reappointment of 11 of those 12 regional Fed members. And so that does reduce that risk somewhat. I think the chair change in leadership next year could, to your point, bring about a more dovish regime shift from the Fed. And that could come at a time when we are seeing strong impulses on the growth front from the fiscal side. And so that suggests the greatest risk next year is not so much a recession, but actually the opposite, that we could see a more reflationary environment where growth is resilient and we start to see an upswing in inflation with the Fed easing policy.
Well, Laura, you mentioned the fiscal side and deficits remain elevated, and there's growing concern about how that could all spill over into Treasuries. Where could the pressure show up?
I think it's going to show up in the 10-year yield. Despite the Fed having cut rates, even 75 basis points since September, we have yet to see that play out in terms of a rally in bonds. And looking at the 10-year in particular, we suspect that that's going to remain relatively range bound around that 4 to 425 through the end of this year and through next year. Now, we do expect there's going to be greater volatility around that given a number of the factors coming through. But this is not going to be an environment, to our mind, where we're going to see those yields certainly return to the levels that they have been over the past decade or so.
Well, BlackRock is turning bearish on long-term treasuries. They're citing AI-related financing that could push up borrowing costs. Do you see AI investments finally shifting to execution?
I think that's the clear risk, is that, AI is quite capital intensive. Are we going to see this actually being deployed and importantly, getting the return on investments from some of this large spending? But to our mind, actually, if we look at AI, it's going to be a crucial pillar of the US growth backdrop. It's already added about 1/5 to the US GDP this year. We expect it's going to remain elevated. And from an investment lens, we're actually seeing the greatest risk reward profiles in credit and private markets. So financing the build out of AI, because we're still in the early innings of that. Investors have focused largely on equities and data centers, but to our mind is looking at municipal government bonds, utilities, infrastructure debt, and those private markets to finance the data centers and importantly the grid upgrades, because the race for AI is really becoming more about a race for capacity, a race for power as well.
So finally, Laura, markets are increasingly convinced that the ECB will hold rates after pulling off a soft landing. In that environment, where do you see the biggest opportunities?
I think what we're seeing is a structural reset of European assets. To our mind, the German Bund yield at the 10-year should be above 3%. We think the euro should be higher as well. And so it's not necessarily looking at the core rates in European government bonds, but still finding attractive carry opportunities in the periphery like Italy and Spain Spain, where growth is actually becoming, it's quite robust in those regions. And as well, looking across the credit complex, not just in European investment grade credit, where we still see favorable risk reward, but I think for investors to take on that regional diversification, looking across the globe for some of those pockets in fixed income, like securitized, like senior loans, CLOs. Really, we think this is going to be an ample opportunity set in 2026.
That was Laura Cooper from Nuveen. Don't forget, you can watch more videos on Reuters.com.